Most people pick their investment strategy the same way they pick a restaurant. Whatever their friend recommended, whatever looked good on the drive home, whatever felt safe. Real estate or stocks, landlord or investor, bricks or bites. I spent 3 months running the actual math on both. Not the napkin version people show at dinner parties, the full version, including everything you never see on a YouTube thumbnail. And what I found completely changed how I think about building wealth. Let's run the numbers. Meet 2 people, David and Chris. Same age, same city, same $50,000 saved, same $55,000 salary. The only difference is what they do with that 50 grand. And over 20 years, that one decision quietly builds 2 very different financial lives. David uses his $50,000 as a 20% down payment on a $250,000 rental property, a modest 3-bedroom house in a decent neighborhood. He takes out a 30-year mortgage at 7% interest, monthly mortgage payment, about $1,330. He finds a tenant willing to pay $1,800 a month in rent. On paper, that's $470 a month in profit before he spent a single dollar on anything else. David feels like a genius. Chris takes the same $50,000 and drops it into a total stock market index fund. No leverage, no tenants, no keys to hand over. He sets up an automatic contribution of $300 a month and doesn't think about it again. His coworkers ask him what he's investing in. He says, index funds. They nod politely and change the subject. Nobody's impressed. Day 1, David has a house, a tenant, and a very good story to tell at dinner parties. Chris has a brokerage account and a confirmation email. That gap in feeling? It never really goes away. But feelings and math are 2 completely different things. Here's what David's first year actually looks like. His mortgage is $1,330 a month. Rent is $1,800. That's $470 in profit before he spends a single dollar on anything else. But then, reality shows up. Property taxes, $250 a month. Insurance, $125 a month. 1 month of vacancy between tenants, $1,800, gone. Water heater replacement, $1,200. That's not bad luck. That's Tuesday, when you own a rental. By year 3, David's actual cash in pocket, after every real cost, is somewhere between $2,000 and $4,000. Not per year. Total. The number that sounded so good on a napkin looks very different once you include what the napkin left out, and none of that counts a single hour of David's time. The 10 p.m. calls about a leaking faucet, the Saturday showings when a tenant leaves, the lunch break spent coordinating an HVAC repair. When David tells people he's making $470 a month on his rental, he is technically correct. He is also technically leaving out most of the story. Chris, meanwhile, is doing nothing. Year 1, his $50,000 grows to about $55,000. Year 2, maybe $61,000. There's no key in his pocket, no tenant texting him, no asset he can point to from his car window, just a number on a screen, a number that keeps quietly getting bigger. Chris's friends don't ask him about his investments. Nobody brings it up. There's no key to hold up, no driveway to point to, nothing to show at the barbecue. By year 7, his portfolio has crossed $135,000 to $150,000. Including his monthly contributions, he hasn't made a single decision since the first one. That's not laziness. That's compound interest doing the one thing it was designed to do. Reward patience. Now here's the part where I have to be fair to David, because real estate has one weapon that stocks simply cannot match: leverage. David used $50,000 to control a $250,000 asset. That's a 5-to-1 ratio. When that property appreciates 3 to 4% a year, he's earning appreciation on the full $250,000, not just his $50,000. By year 10, that property is worth roughly $335,000 to to $350,000. His equity after paying down the mortgage sits around $170,000 to $184,000. His portfolio is approximately $165,000 to $180,000, almost identical. But the path to get there was nothing alike. David took on $200,000 in debt, concentrated his entire investment in one zip code, spent hundreds of hours managing an asset, and still ended up roughly even with a man who literally did nothing. By year 20, the story gets interesting. David's property is worth $450,000 to $500,000. Mortgage nearly paid off. Equity somewhere between $400,000 and $500,000. After 20 years of repairs, turnover, taxes, and at least one major renovation, his net cash flow above total expenses is roughly $40,000 to $80,000. Chris's portfolio at 10% average annual return with $300 monthly contributions, approximately $420,000 to $460,000. Total contributions of $122,000. The other $300,000 plus is pure compounding. No debt, no tenants, no 2 a.m. phone calls about a broken pipe. Net worth? Roughly the same ballpark for both. But here's the question nobody asks at the comparison stage. What did each of them give up to get there? David gave up time. He gave up flexibility, sleep, and liquidity. His wealth is locked inside walls. Selling takes months and costs 6% in fees. Chris can liquidate his entire portfolio by Tuesday afternoon. No agent, no closing costs, no waiting. That's not just a financial difference, that's a life difference. I'd be lying if I told you index funds were perfect. In 2008, the market dropped 37%. In March 2020, it fell 34% in a matter of weeks. If you had $150,000 in your portfolio and watched it fall to $95,000 in a few weeks, that's not a number on a screen. That's gut-wrenching. And the data is clear. Most retail investors panic sell during crashes and buy back in after the recovery, locking in losses at the exact worst possible time. There's also no cash flow. Unlike a rental property, index funds don't send you a monthly check you can spend. Dividends exist, but on a total market fund, you're looking at maybe 1.5 to 2% yield. On $150,000, that's about $200 a month. That's not replacing anyone's income. And there's the leverage gap. Chris used $50,000 to control $50,000 in assets. David used $50,000 to control $250,000. That 5-to-1 leverage is powerful when property values rise. And it's the main reason real estate creates more millionaires than the stock market in many surveys. Real estate wins in specific, identifiable situations. If you're in a market where rent is at least 0.8 to 1% of the purchase price, the cash flow math works in your favor from day one. If you're willing to treat it like a business, not a side hustle, screening tenants carefully, budgeting for repairs, building systems, the returns can genuinely exceed stocks. And house hacking. Live in one unit, rent the others. Your housing cost drops toward zero while equity builds. The stock market simply cannot do that. Index funds win when time is the scarce resource, when simplicity is worth something to you. When you want diversification across thousands of companies instead of one building on one street. They win when liquidity matters, when you might need access to capital without a 6-month selling process. And they win when the long game is the only game you're playing. David and Chris both made smart decisions. Neither one was wrong. What would have been wrong is picking either one based on a podcast clip or a real estate meetup or something your uncle said at Thanksgiving without ever running the full numbers for your own situation. The math on both paths is real. The risks on both paths are real. The time costs, the tax advantages, the leverage, all real. The only version of this comparison that matters is the one built around your income, your market, your risk tolerance, and your actual life. So before you commit to either one, run your own numbers, all of them, including the ones that don't fit on the thumbnail, because the answer that includes everything is the only answer worth trusting. Marcus Capital. The numbers don't lie.